Here are my top 7 stocks to buy right now. We'll go over alternating one stock that I own, followed by one stock I'm still researching, as we alternate our way up to a stock that's increased by 2.5x over the past year, but may have room to double again. And as always, at the end of the video, I'll show every stock that I'm currently investing in. But to start off, to show you that I put my money where my mouth is, here is my actual Charles Schwab stock portfolio. If we look year to date, it's currently up just under $12,000. And if we were to zoom out to the 1-year view, it's increased over 50%, up $66,000. But it hasn't all been smooth sailing. We can see some big jumps and then drops here on the chart. And in fact, in just the past month, I've seen a $16,000 drop in my portfolio, which is kind of just par for the course when you invest in these high growth, high volatility stocks. But when you keep your eye on the long game, you can see some pretty spectacular results by investing in these sorts of companies, which leads us to the first stock in my portfolio, which was also the largest investment I ever had until a couple other stocks actually outgrew it over the past couple months. And here's why this company is so interesting. Datadog sits at the intersection of the twin trends of data and AI. The company offers a cloud-native way for companies to understand what's happening below the surface of the business. The way they describe it is they make a dashboard which allows executives to see their business through a single pane of glass, looking at securities, application, and infrastructure. And this allows them to make smarter decisions about the business. Now, I currently have 146 shares in this company, which is worth around $17,500, which is actually down slightly over my current cost basis, with just under a $1,500 drop. Now, the way Charles Schwab calculates these numbers is a little bit odd because they do first in, first out accounting, which means if I bought more shares at a higher price, it could cause the cost basis to look worse than it actually is, considering I've traded in and out of this company before. But here's what makes Datadog unique among some of the cloud monitoring services. In the company's most recent quarter, their revenue grew 26% year over year to $590 million, which puts them on track to a run rate of more than $2 billion this year. And that's with 396 customers who spend over $1 million a year with the company. But that's not unique to this quarter. If we look at the company's earnings over the past year, this quarter they grew 25%. They grew 25% again last quarter. The quarter before that, another 25% growth. This company has been consistently growing at scale for a substantial period of time. And during the past year, they've taken their net income from a negative number to a slightly positive number. Now, don't get me wrong, this isn't a wildly profitable company yet. They're still in the growth phase, but they are at a point where the company is transitioning from growth at all costs to a very high rate of growth while producing substantial profitability. And considering this company is growing faster than the overall data market, and they're operating in the data and AI space, which is already compounding on itself, these twin trends are boosting a company that has already proven that it can execute, which is why this is one of my largest stock investments. But next, we'll shift to a stock that I don't currently own, but I have covered before, and the stock price is up nearly 50% from when I covered it earlier this year. And that company is Palantir. Now, Palantir is a really fascinating company because they're incredibly secretive, but they're also growing incredibly quickly in public. So here's a quick rundown of what Palantir does. Palantir offers data services to organizations that need a high level of secrecy. Everything from medical companies to banks to national security all fall under Palantir's umbrella, and they've gotten really good at operating in this space. They have 3 major products, which I've covered in previous videos and I won't dive into here, but effectively what these products allow Palantir to do is automate the data workflow that operates within companies. They can organize all the data for the company. They can take a massive organization like the US military and get their data organized for them. They then offer services to run data analytics on top of this baseline, which allows the company or organization to make real-time decisions based on what's actually happening in the field, and to do all of it without risk of their data becoming public. And since one of the core reasons that Warren Buffett likes to invest in companies is if they have an economic moat, basically some competitive advantage that no one else can copy, that puts Palantir in a really strong position. And they even have some very specific tools that make them basically unique in their industry. For example, their Apollo software, which allows them to deploy software updates basically anywhere in the world, which might not be that big of a deal if you operate a company in downtown Manhattan, but if you're working in the US military and you need an update to the latest data analytics while you're in the middle of the desert or the ocean, this technology is essential. Now, this company is a relatively similar size to Datadog, and they're not growing quite as quickly, with 17% growth a year ago, 12%, 16%, and then 19% in their most recent quarter. But their overall revenue growth has been accelerating over the last few quarters, and they operate in a slightly different segment from Datadog, who focuses on companies hosting their data in public clouds, where, yeah, security is important, but it's not national security level security. And so at least in the short term, I don't see these two companies really competing directly. Okay, but let's move away from the super secret government-focused businesses and to a fintech company who is focused on creating the future of banking for consumers. And they're growing at 30% per year while doing so. SoFi. Now, I've talked about SoFi before on this channel, and we'll go over what the company does, but I first want to direct your attention to this chart, which caught my attention about a month ago. This chart shows the price to sales ratio of SoFi over the past year, which is basically a representation for how expensive the company is. It's the company's stock price divided by the amount of revenue they're creating. And we can see that this has dropped dramatically from where it was in 2022 to a current price to sales ratio of 3.2, nearly the cheapest that it's ever been. Which means if SoFi is able to match even a slightly higher valuation that they saw before, it could leave substantial upside in the stock. Now here's why there might be a reason for that valuation to go up. SoFi basically operates like three businesses in one. You have their financial services business, which is everything from the SoFi app to the SoFi credit card. These are their very consumer-focused products, which they market with viral campaigns on TikTok, whose goal is to attract new customers. They then funnel these customers into more valuable areas of the company, like lending, where a SoFi customer can become a long-term consumer of all of SoFi's services and make a lot more money for SoFi. This is kind of the cash cow of the business. And then underlying all of that is SoFi's long-term value, at least in my opinion, which is their technology platform segment. This is basically the technological backbone that is powering all of SoFi's services. And they even provide the technology that is powering other companies' payment solutions as well, including companies like T. Rowe Price, H&R Block, and Fundbox, and one of SoFi's biggest competitors, Robinhood. What makes SoFi unique is the way that they're able to apply all these different areas of business in a cohesive way. By having their own technology platform, they can improve the experience for users, doing things like offering rewards when a user pays off their loan on time, or giving someone credits to earn a free stock if they sign up for a credit card. And of course, the ability to transfer money that doesn't take 3 to 5 business days, because they're all operating on the same walled garden ecosystem. And every new product SoFi launches makes the rest of their products more valuable. If this is starting to sound familiar at all, this is basically the exact approach that Apple has used to grow itself into the multi-trillion-dollar behemoth that it is today. And the big bet SoFi is making that they'll be able to win customers from the 500 million plus legacy bank accounts and onto their platform that actually cares about consumers. And considering the company is now profitable while growing their revenue at over 35% year over year, it seems like consumers are pretty happy with SoFi as a business. And so if the company is going to maintain their current price to sales ratio, the only way they can do that is for the stock price to go up, because their revenue keeps increasing. And if that ratio goes up at all, it could give a multiple to SoFi's increase, which is one of the reasons that I'm so bullish on this stock and why I currently own over 2,000 shares of the company worth just over $15,500, which has made me around $1,000 so far. Oh, and by the way, Charles Schwab likes to give these A through F ratings on stocks. As far as I can tell, these are just based on some kind of valuation metric, because they rarely predict where the stock price is going to go. I had one company, CrowdStrike, which I owned for like 3 years and made a 300% return, and it had a D or an F rating the entire time. So I don't put a ton of stock into those ratings. But let's now move into another investment, which, unlike the stocks we've talked about so far, doesn't move up and down nearly as much with the rest of the stock market, which is great, because if the government has to flip a switch and try to get the economy back on track, this $1 million asset can appreciate at its own pace. And if you haven't guessed by now, I'm talking about the world of fine art. Now, before our sponsor at Masterwork came around, only millionaires and billionaires could afford to invest and profit in this market. But Masterworks has brought the power of fractional investing to the art market. You can invest in shares from legends like Picasso, Banksy, and Basquiat without needing to buy a whole painting yourself. You might have seen my walkthrough video on them 2 years ago, in which they only had 17 paintings offered on the platform, but they now have over 300 in their collection, and that number will continue to grow throughout this year. Masterworks has generated over $45 million in art sales and distributed the proceeds to their investors, without those investors ever needing to show up in a suit and tie to attend an art auction. And each of those 21 sales that Masterworks has had so far has resulted in a profit to their investors, which is why over 920,000 users have joined the platform today. Now, in the past, offerings from top artists have sold out within minutes, but by using the link in the description below, row, you can skip the waitlist and sign up for Masterworks today. And you can scan the QR code on screen or go to masterworks.art/fintech. Now, you know past performance is not indicative of future results, and investing results may vary, and you can see the full list of regulations and disclosures in a link in the description. But now let's turn our attention to a stock that's doubled in price over the past year, while adding over $100 billion to its valuation. AMD. Now, AMD operates in a similar space to Nvidia, which saw their stock price rise 241% over the past year to a current market cap of over $2 trillion. So considering AMD is 9 times smaller than Nvidia, there could be room for this company to still grow. And here's why that might happen and what would prevent AMD from achieving that level of success. Now, AMD is a chip maker, and for a long time, they were one of the largest chip makers in the world. They're one of the few companies that compete with Nvidia in making graphics cards, which are essential for everything from playing video games to self-driving cars to running the latest AI models that power things like generative AI. In the company's latest earnings presentation, we can see some of the areas that they think differentiate them from someone like Nvidia. They talk about how they have a broad portfolio where they produce not just GPUs like Nvidia does, but also CPUs, which is kind of the core brain power that operates most computers. I like to think of it this way. A CPU is really good at running a bunch of really complicated calculations in order, which is how computers were originally created. GPUs are good at running a bunch of smaller calculations all in parallel, which is really great if you need to push a bunch of pixels to a screen or in certain processes like training an AI model. You really need both kinds of computings, and in the long term, both types of chips are going to continue to be manufactured. A lot of the focus has been on the GPU market over the past few years, which isn't a surprise with technologies like blockchain, metaverse, and AI all making use of it, but I wouldn't be surprised if we see a swing back toward focus on the CPU market in the future, which AMD is better equipped to handle than almost any other company on earth. On top of that, the company focuses on how much they're used in big data centers with innovation in AI, cloud, and enterprise. And of course, they're quite popular in the open source market. Nvidia is notorious for making software that only runs on their chip specifically. AMD has a little bit more of an open ecosystem, which could give them an advantage if enough open source developers create tools that work on their chips. Now, at the same time, not everything is perfect at AMD. Their revenue in 2023 actually dropped 4% year over year, where they saw lower revenue in their client and gaming segment, although they did see more growth in their data center revenue, which is an area where big companies like Google and Amazon and Microsoft are buying AMD chips to run their clouds on top of. But we did see a slight reversal in the last quarter, where revenue increased 10% year over year for the most recent quarter. And of course, this is a very mature company, so we're not expecting to see the crazy growth rates that we see in a stock like SoFi. But we do see more profitability, with GAAP gross margins of 46%, meaning around half of the revenue that they bring in turns into real profits. Now, will AMD catch up to Nvidia's stock price in 1 or 2 years? No, that's not realistic. But is there room for the stock price to grow from here? Absolutely. But turning now away from hardware and toward a stock that I've owned for years that has promised to 5x their revenue over the next 5 years. Cloudflare. Now, I've described Cloudflare before as the most innovative company on earth, and that's one of the reasons I own 160 shares in this company worth around $15,000, and that's made me around $4,000 since my initial investment. Cloudflare is building what they call the connectivity cloud, basically building a backbone that can replace the outdated 1960s technology that the modern internet is built on top of. And they're using this backbone to continually launch new products that improve the experience for their customers. If we take a look at just the sheer number of products this company has, they have platforms for zero trust security that they've entered recently. They have mobile protection, infrastructure protection, development platforms, ways to register your website, and private ways to browse the internet. All of these different areas could be a company on their own, but because Cloudflare runs the physical hardware that a lot of the internet runs on top of, they're able to build all these solutions directly into their platform. The company is currently boasting 30% of the Fortune 1000 as paying customers, with 95% of internet users within 50 milliseconds of their network. And probably the craziest stat of all, they've had a compound annual growth rate of 46% for the last 5 years. That may not sound that high, but let me put this into perspective. If you were to grow 50% for 1 year, you'd be 150% bigger. But if you were to do that for 5 years in a row, you would actually be 7.5 times bigger than you were before. And that is how much Cloudflare has grown their revenue over the last 5 years. And if you look even more more recently, 3 quarters ago, the company was growing their revenue at 30% year over year, and they've maintained a pretty rock solid revenue growth rate since that time. And it's been around a year and a half since the company's CEO first promised to 5x their revenue over a 5-year period. And considering the company is currently sitting at around a $1.5 billion revenue run rate, that is still very achievable for the business. And it's also partly why the company's stock price has increased 68% over the past year, with some substantial gains since November of 2023. But now let's talk about a stock that I've never covered before on this channel that's a little bit outside the usual tech stocks that I cover, but is growing at an absolutely massive rate. DraftKings. DraftKings is still a relatively small company, worth a little bit under $20 billion currently, but this company has increased in price by 142% over the past year, with a lot of that being driven by their absolutely massive 44% year-over-year growth rate in their revenue, which has now reached over $1.2 billion. The company has continued to beat earnings expectations basically every quarter that they've been issuing them, and they've even entered the world of mergers and acquisitions, acquiring the #1 lottery app, Jackpot, for $750 million. And of course, the company is a cash cow, generating $310 to $410 million in free cash flow expected for the next year. So this is a little bit of a different space than a lot of the software as a service and tech stocks that I cover, because DraftKings operates in the world of sports betting. If you're not familiar with the sports betting world, it's basically where you can place bets on your favorite sports teams for who's going to win a game, how many points they're going to score, other specific events to a specific sport. And it's a way for making fans stay more engaged with the content, which is why a lot of sports franchises and media companies are getting on board with the industry. Now, sports betting was illegal in most of the US just a couple years ago, but with those regulations loosening now, it's opened up a gold rush for this new market. And there's basically 2 major competitors to taking the top spot right now. FanDuel, which currently commands 39.3% of the market, and DraftKings, which owns around 34% of the market. These 2 companies together command by far the majority of the US market. And FanDuel's parent company, Flutter, was listed on the New York Stock Exchange with a valuation of 30 billion British pounds. And interestingly, it's by looking at Flutter's earnings presentation from when they first went public that we can see the potential size of this market, which they estimate as 228 billion GGR in regulated markets. So they're basically saying, yes, there's steep competition between FanDuel and DraftKings, but even if they didn't gain any ground on each other, there's still a massive market for both of them to go after. And like most new industries, we're likely going to see 1 or 2 big winners in the space. When ride-sharing first came out, Uber came onto the scene and took over everything. And now Uber and Lyft basically command the entire market. I wouldn't be surprised if we see something very similar in the sports betting space, with maybe FanDuel winning out, maybe DraftKings winning out, but more than likely these 2 companies sitting at the top of the pile when it's all said and done. And considering that combined, they're currently only worth $50 billion, there could still be substantial upside in DraftKings stock. And DraftKings, by the way, only made around 15% less revenue than FanDuel did in the most recent quarter, and yet the company's valuation is around 33% lower than Flutter's parent company. Now, that's not taking into account different margins and different areas that these 2 companies operate in, but it shows just one more potential opportunity for DraftKings, which, as the first publicly listed of the sports betting companies, gives it some advantages to use the additional money that they raise from investors to do things like acquire other companies, which will help grow their overall market share. But let's turn now to another fintech stock that is up 150% over the past year and is by far the fastest growing stock that I own, Nubank. Now, Nubank isn't a stock that most people in the US and Europe have heard of, which is a shame because I currently own 1,200 shares in the company, and just that initial $10,000 investment has made me $3,000 in just a matter of months. And of course, for investors who have owned it over the past year, they've seen a 162% increase in their investment, more than 2.5x what they would have put in. And here's what makes Nubank special. Nubank is a Brazilian company. In fact, they are Brazil's largest digital bank. So in order to understand Nubank, you need to understand what's happening in the economy of Brazil today. The government in Brazil is currently investing aggressively in modernizing their economy and making themselves competitive on the global stage. One way they're doing that is through digital banking services. services. And so Nubank obviously has a bit of a helping hand on their side from the Brazilian government. At the same time, Nubank makes some really exceptional products that customers in Brazil love to use, which is why the company is growing at an absolutely ludicrous rate, with 19.3 million new customers joining the platform in 2023, off an already large base of 54 million customers 2 years previously. Currently, 53% of all of Brazil's adult population is using the platform, which makes them the fourth largest financial institution in the country. But the company isn't just satisfied with acquiring new customers. They're also making more money per customer, with a 23% expansion in the average revenue per customer year over year. Now, what's interesting with Nubank is they're also somewhat transitioning into becoming a super app, where they're not just doing one thing, digital banking. They're kind of supporting all aspects of a consumer's life. For example, a customer could use Nubank for banking, but they can also do shopping directly on Nubank. The Nubank shopping app alone reached 255 million visits in 2023, with people able to buy products on the app ranging from appliances to smartphones to smart TVs. And that's on top of all the other services that the company already offers on their platform, including insurance. So the big question with Nubank is what will be next for the company? Will they be able to successfully expand outside of Brazil and into other markets, like for example, Mexico? And if they're able to successfully do that without the support of the Brazilian government directly behind them, this company could become an absolute behemoth on the world stage. And I promised at the end of the video that I would show you my entire stock portfolio, so here it is on screen. It's about as diversified as my current diet of a Chipotle burrito every day, but subscribe if you want to see more videos on growth investing.